Hello and welcome to the first of 4 educational program series provided to you by the Berks County Area Agency on Aging. My name is Ann Barlet and I'm the Manager of Community Outreach and Education for the agency. Our first of the 4-part series, our first series was on retirement planning and the process and the steps that one might consider when thinking about retirement. The segment today is focused on financial planning aspects of retirement. My guest today is Tricia Ludgate, and she is with the Financial Planning Advisors Group, and she is a financial planning advisor. And welcome, Tricia.
Thank you so much, Ann.
I think that I, of course, want to know everything I can possibly know about planning for my retirement in terms of financial well-being. So let's start right in with what can I do, the people, those of us looking ahead, what can we do to help in preparing for retirement?
Well, retirement actually starts way before you're going to retire.
Oh,
but
no.
of course,
Okay.
we do gear up for retirement a lot faster, and we focus on it a lot more when we are nearing retirement, like you are, and we have talked about that. Mm-hmm. But the whole idea is to don't wait to save. You always want to be saving for retirement. It doesn't matter if you're in high school or in college. If you start a good habit of saving, then you will be in a lot better shape when it comes to retirement. So,
sure.
And I'm sure that
that makes sense, yes.
Right.
All righty. And so, in considering that, what are there some defined things, goals to strive for then?
Absolutely. One of the things that we say, a financial planning rule of thumb, is if you save 15 to 20% of your income all through your lifetime, you will be much more prepared for retirement. And this means across the board with everything. Another thing that people forget about doing is protecting their credit. And you can do this at any age. So it doesn't matter if you're, just a few years away from retirement, like hopefully you are, or if you're in your first job, or even preparing for that first real job. What you want to do is always protect your credit. There are 3 different reporting agencies, and you have access as a consumer to be able to go on annualcreditreport.com, and if we have that on that first slide.
Yes, we're going to show the first slide now that it gives us some of the tips for savings for every age. And so you basically said start now, don't wait. It's never too early or too late to start saving.
Right.
To strive for the 15 to 20%. And then our third bullet there says protect your credit rating like it's cash, and you'll see the site www.annualcreditreport.com.
Right, and that's really important to remember because there are a lot of different websites out there, but this is actually a government site even though it doesn't have a .gov at the end of it.
Yeah, okay.
And once a year, all of us are entitled to get their credit report from all 3 different reporting agencies. So,
and does that cost me anything?
No.
Being thrifty.
Right. And
okay.
that
so
is why I want
to
distinguish that from freecreditreport.com, which is not a government site.
Okay.
But people think that this isn't free. This is a free service that's provided through the government. Okay. So good. When I say protect it like it's cash, it really is like cash because you will get lower rates on any loans that you're going to be taking if you have great credit. So it saves a lot of money. The other thing that's really important for anyone at any age is to have an emergency fund. An emergency fund is going to be there for you when you have an unexpected expense. People call and say, wow, I had this terrible, inspection. And it's going to cost them $1,200, and they don't have $1,200.
Or in the case that I had this summer, of course, right before the hot heat wave began, the entire air conditioning system went. So that was certainly not an unexpected expense that happened, and I wanted to have the central air conditioning put back in, and so that was something that came up.
Right, and if you don't have an emergency fund, then you end up going to take a loan. Maybe you have a family member that you can loan from for no interest. That would be ideal. But many of us don't have that luxury. And so if we don't have an emergency fund, we put it on a credit card. And then maybe it's creating debt or it's increasing the amount of debt that you already have. So the emergency fund's really a good idea.
So let's then specifically, and luckily for me, I did have an emergency fund,
Thank
so
goodness.
it wasn't a big hit for me either, although now, after I go, wow, that was a big amount. But so let's talk about the emergency fund specifically.
Okay.
And is there a guideline for that? Should it be, you hear different things. It should be X amount of months that you can live off of. Is there a guideline on that? How much? Or is it rated whether you're single or a family? Can you help
And
us
it's going to
with that?
vary based on what I think more so on people's comfort levels.
Okay.
So I'm a person that wants to have an emergency fund that covers 6 months of expenses. So I look at what my expenses are and how I would have covered 6 months of expenses if suddenly I'm unemployed, if suddenly I'm disabled, something comes up and I no longer have a paycheck, what am I going to do to pay my bills? So for me, I think 6 months. For somebody else, I say the minimum is really 3 months or 3 to 6 months. I do have a lot of clients who don't feel comfortable with just that. They want to have like a whole year of expenses. So it really does vary based on the person.
Okay, all righty.
But it's just important, and you want to continue to have that emergency fund throughout your life.
And can that emergency fund, obviously it's an emergency, so we need access to it fairly quickly, I would assume, because an emergency arose. Is it okay to keep it in a general, just quick savings account that you might have, or is there another account that can also be drawn from quickly that you may want to think about putting that emergency fund in?
Well, it's going to depend on how disciplined you are.
Okay.
So for some people, if you're very disciplined, you can have everything together in one savings account. I like to have things differentiated. So for me personally, I like to have my emergency fund, and I actually have it labeled emergency fund. And I have a separate one for my vacation, and I have a separate one for my taxes, and I have a separate one for different things. And that's the way I differentiate them. But you can have them all together. But it really comes down to how disciplined you are in spending it. I also like to have an emergency fund somewhere that is not so accessible. And that way I think, well, if you don't have an ATM card, you may not be tempted to use it. And so if it's a little bit less accessible, but yet you can still get to it if you need to pay that mechanic or you pay the service provider for the new air conditioning unit. You want to have access to it within, 2 to 3 days. Maybe it's just a matter of transferring it from one place to another.
Okay. All right. Good. All right. So we talked a little bit again about kind of starting and making sure that we are becoming prepared even before we're starting to think about, oh my gosh, and panic at the considering retirement and what we need. So let's look at back to retirement, and obviously increase your savings. Don't wait. And a savings goal of 15 to 20%. So if we start small, what do we do? How can we, what do we do? Where do we go?
All right. So when you think of retirement specifically, this is retirement when you are older. So I started a Roth IRA a long time ago for my daughter who had turned 18.
Okay.
And she had income from a job, and I said, okay, well, now that you have earned income, you can start a Roth IRA. You're 18 years old. So she said, oh, is this from when I graduate from college? Is this my retirement from college money? And I said, no, this is your retirement for when you're in your 70s and your 80s. So I just want to differentiate that, because really retirement accounts will have a penalty if you take it out before age 59 and a half. So you don't want to put money into that you're going to be using for the set of tires, or you're going to be using for your vacation next year, or the deck that you want to put on your house. So this is money that you really want to make sure that it is for retirement. So there are different ways. You have employer-sponsored retirement plans. Those are also like 401ks, 403bs, government 457 plans. My little firm, we're very small. We have a simple IRA. These are all employer-sponsored retirement plans.
Okay.
And I'm sure you've heard of them, Ann.
Well, yes, I have. And therefore, it's good that if your employer offers any of those things, to at least investigate it, even though it might be your first job out of college.
Right.
And you're not even thinking about retirement, obviously, but when they offer it, or at least information on it, to check it out, to start looking at what it is. Maybe there's a percent amount that you can give up to, or recommend, or something, and at least investigating and maybe beginning something, because
Sure.
it's much more simple if it's automatically deducted, I would think, from one's account before it even gets into your hands to
Yes,
spend.
exactly, and that was my next point.
Oh, okay.
It's the easiest way to start saving for retirement, or for saving for anything, is to make it automatic. And if you don't see it, then you won't spend it, and you don't generally miss it as much. So the way retirement plans through an employer works is sometimes you actually get a match, but you only get that employer money matching if you put money into it. So you definitely don't want to give up that free money. That would be foolish. If your employer is giving you a 3% match, you would have to put in 3%, and then the employer will give you 3%. And now you're at 6%. And I just said a little while earlier, if you save 15 to 20% all through your life, you're probably going to be able to sustain your same lifestyle that you have now in retirement.
And we all know that obviously the costs are going up and up and up.
Absolutely.
So obviously we want to start early to do so.
Absolutely. If you make it automatic, you can do it that way. Even if you don't have an employer-sponsored retirement plan, you can start saving automatically into your savings account. Once you've built up that emergency fund, you can start your own retirement account. Okay. IRAs, Roth IRAs, things such as that.
So I can, if I'm really serious about it, think, how else can I also add to that, and call a financial planning person, advisor, and sit down and say, I'd like to start something. We know that in a general savings account, the interest is so
it's practically nothing.
I was going to say, yeah, low. Nothing, that it might be best to sit down and say, I do want to put something aside and maybe start something on my own, outside of the employer.
And if you didn't want to meet with an investment professional, maybe you're intimidated, you can actually go to your bank and set up an IRA there.
Okay.
And it would be either in a bank account or in a money market account or a CD. And like you said, right now, money markets and savings and CDs are not paying very much. But everything is cyclical, and maybe interest rates will start going up at some point, and you will get higher savings. So that's one way to do it.
Okay.
And keep in mind that 15 to 20%, and I do reiterate that because it really is important, and that's through all sources of savings. But if you're able to do that. So like Ann, you said to me, well, I'm already putting money into a plan, what can I do? So what you can do is you can bump it up.
Okay.
So you can put in a little bit more.
I don't want to be poor. No. Okay, and it is something that you really have to say, I'm going to do.
Right.
You know.
So if you get a little bonus, and you're putting in 10%, say, then that little 10%, that dollar amount's going to go up because you actually got a little bonus, or you got a little pay increase.
Okay.
So hopefully then you don't see it.
All right. So that's great in terms of being able to think ahead, do some strategic kind of thinking and planning.
Sure.
But let's flip that a little bit. And what about folks, retirees, that have no sources of income in terms of new sources? They're not working.
Right.
They've retired. They want to relax, and so now they're going, oh dear. So what should I do? I've planned, and I have no paycheck coming in. What should I do?
All right. So this is okay. Now that you don't have a paycheck, people think, I can't do anything more. What can I do?
Exactly.
The next slide will show you that there are definitely things that you can do.
Okay.
So you're going to figure out which assets you need to use first. So now you're in retirement, you've already done all your savings, maybe you've been really great about it, and you have all these different types of assets. You have bank accounts, you have some CDs, you have an IRA, maybe you still have that 401k, and maybe you have a home that's paid off. What should I use first? Well, always use your non-retirement assets first. Those assets are not protected under the tax deferred account. They're not taxable.
Okay.
You take money out of it, you don't have to worry about it reflecting on your income tax return. So, but I don't want you to deplete your emergency fund, because even in retirement, obviously, you could
emergencies
have
come up.
the roof blow off.
Right,
We could have a
exactly.
hailstorm.
Exactly.
Things that aren't covered by insurance. You know, even with the hailstorm, a lot of people have high deductibles for their homeowners insurance, so you have to be able to pay that out. So you keep that that emergency fund intact.
Okay.
But use the bank accounts first, then maybe go to your CDs, look at what's not paying as much right now. And then for people who are over 70 and a half, they can take the required minimum distributions. These are mandated by the IRS that you must take a minimum out of your IRAs at age 70 and a half.
Okay.
So you can take that IRA money first.
Okay.
And so after you've used up the bank accounts and your CDs and money markets that we're not paying very much anyway, then you use your required minimum distributions. If you still need more, you can take more from your IRAs, but be very careful, because the amount that you take out, you have to kind of gross up to have the taxes paid, because you are going to have income tax withheld. The more you take out, the more your taxes could go up. So you might be in a very small tax bracket, or maybe you didn't have to even file taxes for a while, but now that you take money out of your IRAs, you're going to need it.
They get you.
They do.
Don't they? Okay.
So that's important for that.
Okay.
The other thing that retirees can do is they can, do we have another slide for that one?
All right. What else? Okay, here's some other tips.
So other tips are to reduce your spending. And you might think, oh, you know, geez, you know, how can I do that? There's a lot of little things that you can do to lower your utility bills. You can look at the utility providers. Now that there is a little bit of competition, you can see if maybe you can lower those. You can be a little bit more frugal. Reducing your spending a little makes a big difference when you look at 30 years of retirement. A lot of our retirees now are healthier. They're going to live longer. And hopefully they'll do it in a healthy way, and they'll be able to enjoy their retirement. But you know, saving $100 a month will make a big difference when you look at it over 30 years.
Well, and it really is a juggling act in that,
really
you know, as we age as well, so into retirement, and we've done really well with the contributions of employer retirement accounts and some other things, and we're managing very well. The key is still to reduce those basic pieces of spending, because unfortunately sometimes, and we want to remain healthy, but if something should occur medically, then at any time we could be given, you know, a new medication or a new diagnosis of something that requires a little bit more monies that we weren't counting on either. So it's kind of that balance. Okay, so we can reduce our spending.
Another way to maybe at least find out if there are ways that maybe you're not aware of is to use your agency. The Area Agency on Aging has a lot of different programs that people might not be aware of.
Right, to save periodically throughout the year, take advantages of certain programs that we're aware of as resources out in the community.
Absolutely.
Okay, good.
Absolutely.
And the next one, the other tip that you have on our screen here?
Is to evaluate your investments. I think people should do that annually, maybe even semi-annually. A lot of times people say, okay, well, I have my investments where they are, and they're invested for the long haul, and they're okay. But sometimes they're just not right. We invest for goals and time horizons. So you have a short-term goal. Those investments should be very liquid. They should be very safe, because you're going to be using that money pretty soon. So the things for later in your retirement, maybe you need to take a little bit more risk and have a little bit more of a growth and value funds and not just bonds. So that's a big deal too. A lot of people forget about that. And then we talk, of course, about inflation. You cannot ignore inflation.
And let's throw that up. Yes, you had given me some information earlier that just devastates me. I keep looking at this and want to, I don't know, throw it away or motivates me. So Yeah.
So
You wanna-
3% inflation, and we've been running about 3% inflation, and this is an average. All of these things are averages, an average of 3% inflation. In retirement, oftentimes you spend more on health care, and that's going up more than 3%.
Oh, okay.
So, and colleges, obviously, going up way more than 3%. So tuition, those kinds of things. It's not just for retirees. But yes, $100,000 in 10 years would only be worth $73,742. And then when you look at the 30-year number,
Yeah.
$100,000 today, wow,
Yeah.
you know, wow, I have
Yeah.
$100,000. Well, it's only
Sounds-
really
yeah.
worth $40,101.
Okay.
It's different for us as we're putting money into it. That 100,000 is maybe going to grow to 120 or 140 or 150 before we retire. But for people who are retired and right now that's what they have, their nest egg is not going to keep up with inflation if they have it in a bank account that is only earning 0.2%. So you need to, that's all part of the evaluation of your investments.
Okay.
I'm not saying move all of it. I'm just saying have different buckets for your life.
Okay, so continuing moving forward then, we talked about a couple of those, watch your spending and do that kind of thing. Then we were talking about some other things that we could do, again, considering that I need to consider, all right, you take, sometimes I think you take for granted you've got the paycheck coming in, you're working hard and the pay comes every 2 weeks or whatever, once a month. And then you have to go, okay, I'm going to prepare to not have that incoming paycheck, and what can I do?
Right. So some people have said to me, well, I'm never going to retire. I'm going to work forever. And, they love their job, they love working, they can't imagine themselves not working. And they haven't really prepared much for it. And my retort to that is, what happens if you become ill and you're not able to?
Yep.
Something happens to you. So you really want to prepare. Let's hope that you can work forever because you love your job and you want to, but let's prepare for just in case.
Yes.
So one of the things when you're looking at it is you need to evaluate where you're at. And so it's usually the very first thing that we do with our clients is to look at what they own, and this is a net worth statement.
So let's put that on the screen then as we flow through down what we can do to prepare. So the first is, what you just said is look at where we're at, and that's creating a net worth statement.
Right, so a net worth, you might have heard it, it's basically everything that you own minus what you owe, and then that comes up with your net worth. Well, if I'm working with a 25-year-old couple, they've maybe just gotten married, and they have a lot of college loans, they could have a negative net worth, but that's going to change because they have huge amounts of loans, and maybe they don't have a whole lot in their retirement accounts, they've just started them. It's okay. They don't have a whole lot in their bank accounts. So we're going to constantly be working to make that better. You pay off some debt, you increase the amount of your investments, but you really need to look at everything that you own and evaluate what you owe and if your money is where it belongs.
Okay.
So that's a great way to do it.
Okay.
So then
and you can kind of just sit down yourself very simply.
Absolutely.
And just kind of look at all the monthly expenses, and see what you're taking in, right?
Exactly.
Got
That
it.
is exactly
I can
right
do
for
that.
yourself.
Okay.
Just write it all down. And then, make sure that you understand that if you have a valuable collection or something, it might be very valuable to you, but if you went out to try to sell it, it's only really worth what a buyer's willing to pay. So be very careful when you are trying to add that into your assets.
Okay. Okay. Thank you.
So paying down debt, though, is a big part, and we've kind of talked about this. And sometimes...
And which do you do first? What debt? I mean, you realize you want to pay down all of the debt, but some simple debts, you might have a house debt, you might have a car, you may have some credit card debts because of the unexpected emergency that you didn't have the plan for ahead of time. So what's the rhyme or reason?
Yes, there's good debt, and then there's bad debt.
Okay.
And we talked about a little bit about good debt and bad debt. So what is good debt? Good debt is debt that has a lower interest rate. That's usually if it's tax deductible. So mortgage interest is generally considered a good debt. They're usually lower interest rates, and they also are tax deductible. These things are only tax deductible if you itemize your tax deductions. But if you own a home, generally speaking, between that and the property taxes and maybe some charitable contributions, you are itemizing your deductions. So that's the good debt.
Okay.
The bad debt, home equity loans would also be in on that.
Okay.
And home equity lines of credit, because those are secured by your home. And there are, of course, caveats to all of that, you know, and you don't want to go over whatever the maximums are that the IRS allows. The bad debt is high interest rate debt. And a lot of that would be considered credit card debt, maybe some personal loans.
Okay.
Maybe before you cleaned up your credit rating, you had to take a 15% loan. That is the one that you want to pay off first.
Okay.
Any kind of credit card debt. Those things pay off right away.
Okay. And so then would you say in the next one, understanding our expenses is almost part of also when we've looked at our net worth statement and know what our expenses are?
Well, they're not exactly the same.
Okay.
So the net worth is basically the assets that you own.
Okay.
Your expenses are going to be something different. Monthly expenses can be your fixed expenses, such as your mortgage, your real estate taxes, the things that you do think about. And then there's variable expenses. These are going to be your food. You know, this is how you can maybe reduce your spending. And then those kinds of things. Okay. So you really want to understand your expenses so that you know where you're spending your money. Okay.
And the last, again, there's that word save. Save more into retirement plan.
Right. I mean, if you're going to be preparing,
next,
as you're preparing yourself, I'm saying maybe bump up a little bit, save a little bit more. You know, once you have that debt, that bad debt paid off. You know, I'm not suggesting that you pay off your mortgage. Okay. I'm just saying pay off the bad debt.
Okay.
And you understand your expenses and you have those in line, then you know, nudge that retirement account money up a little bit.
Okay, good. All righty. Let's keep moving. As far as we talked a little bit at the beginning about some employer-sponsored retirement plans.
Right.
So let's put, I see that's on the screen. So we've got, that's how I want to be in my retirement. So let's talk about a couple of those quickly if we can. I know because they're going to be dependent on your employer. So you may or may not have them.
Right.
But there's a couple right here. So
just so you understand, you want to always put in enough so that you're getting the match. You want that free money. Okay. The other things that are available to you in retirement plans, even if the employer's not offering it, you can always start an IRA on your own. Okay. You can go online with a fund company directly, or you could go to the bank, or you could meet with an advisor who could help you. A lot of people are do-it-yourselfers. They think that they know how to do it. They can absolutely just go right online, fill out an application, have it linked to their bank account, and start automatically putting money in every single month. Again, if you do it automatically right out of your bank account, you almost don't miss it, almost.
Yeah, almost.
IRAs,
and the real
Roth
quick
IRAs.
difference between the IRA and the Roth IRA?
It's all about taxability.
Okay.
So IRAs, you get to deduct, the traditional IRAs, you get to deduct on your income tax return depending on what your income is. Of course, there's always those income thresholds. And Roth IRAs are after-tax money. So you've already had that money paid, you paid all your federal taxes on it. Now you have it in your bank account and you're going to write a check and you're not going to get that tax deduction.
Okay. And I can start those at any time, right? And we've got some limits and some guidelines that I would suggest, for lack of time today, that we recommend folks to really research the amounts of money that you can contribute to those accounts, and talk to folks such as yourself, a financial planning advisor, to kind of understand all that, so you know ahead of time as you're doing that planning.
Well, one of the key things that you need to know is that you cannot contribute to a retirement account when you don't have any earned income. So once you have stopped working, you can't contribute more.
Okay.
So people say, oh, well, I'm going to inherit someday.
Yes,
You know, I'm going to be 70 and I'm going to get this money inherited, and I'll just put it in my retirement account. You have to have earned income from wages or self-employment in order to be able to.
That's because you do think you could. Okay.
Absolutely.
Well, and really, we've covered so much in this brief period of time, and tried to prepare a little bit more on retirement and planning, and I've gotten some good advice, thank you, and some help in terms of how I'm looking at what I'm doing, and I appreciate that. And so I'd like to again thank you, Tricia, and I'm going to have the last slide up. Remind you all that my guest today was Tricia Ludgate, who is a financial planning advisor with Financial Planning Advisors Group. And please feel free to give Tricia a call or call our agency if you'd like some more information about our programs and services and our retirement planning series. Thank you.